Thank you for joining us this morning in this installation of Benchmark International's webinar series. As always, we are offering some guidance and insights today to owners of small, medium-sized businesses as they think about or prepare a potential exit or growth transaction for their business. Today, we're going to be discussing an issue which we should have gotten to a long time ago, but we wanted to make sure we got the right people in the room. We've got them here today, and this deals with insurance. Too many times we see insurance come up during a deal and cause a problem. And in reality, it should be the opposite of that. That's what insurance is about, making problems either go away or not happen, right? So we finally got into this. This is going to be an important one, and I'll be moderating today. My name is Quentin Johnston. I've been at Benchmark for about 15 years and started working in mergers and acquisitions in the mid-90s, and including working with Marsh all those years ago. So we have two gentlemen here from Marsh today who have some really deep insights and perspective and experience on the specific items that we're going to cover for you today. Marsh, if you don't know, which I assume everyone does, but they are the world's leading risk management and insurance broker. And with that, I will let our guests introduce themselves.
Appreciate that, Clinton. Walter Viteri. I am the regional executive in South Florida. I have about 25 people that report to me in a multitude of industry focuses, primarily private equity and M&A. It's a pleasure to meet everybody.
Clinton, thank you for having us. My name's Kyle Helmus. Been with what is Marsh McLennan now for just over 10 years. Part of that process being in the private equity world, working with Walt and his team down in South Florida, and then obviously honored to be here working with Benchmark and the team here.
So today's topics, we'll put those up on the screen there. We're going to cover the four things that when I got together with our team leaders here at Benchmark, what are the things that we're seeing come up most often? What's slowing down deals? Where are our clients potentially losing value? What are buyers most interested when it comes to risk management and insurance? So we've narrowed this down to four topics today. Although we could go on for hours, we're going to get this thing done pretty quickly. So the agenda's there on the board. And with that, we'll jump into the first issue. So first, let's talk about due diligence. Wish we didn't have to talk about it, but it's part of the life of a deal. Right. So to review for everyone, kind of four phases of selling a business. You have something that's called deal prep, where you're getting ready to go to market. You're spreading the financials. You're looking at the marketing strategy, writing out the marketing materials, and that takes a couple of months to get started. That's what we'll call phase one. Phase two, you go on market. Buyers are being introduced and learning about the business. Discussions are happening. Phase three, you're getting your letter of intent signed, which is something that we'll talk about today, letters of intent. So make sure everyone understands that's a non-binding agreement, usually 6 to 10 pages that just hits the high points of the deal. Once the letter of intent is signed, the seller goes into exclusivity with that buyer. And then you have the next phase called phase four, which is usually 90 days of due diligence and document drafting. So that's important to lay that out because I want to talk about the pre-marketing stage versus the after the LOI, the due diligence period. So kind of the first phase and the fourth phase. And that's when we see the insurance issue come up. So if someone's not really thinking ahead on the sell side, it comes up after the letter of intent is signed. And the letter of intent is kind of like midnight. Nothing good ever happens after midnight. Nothing good happens for the seller after the letter of intent is signed. So something coming up after the letter of intent, not good. So the other time to bring it up is not while you're on market and things are moving around, but before you go to market, what I call the deal prep phase, that first phase. So, what's your view about when this insurance should be tackled?
So ultimately, we like to say as early as possible, right? As early as possible in that deal cycle, and basically what you're saying there, right? Anywhere from that 12, 24-month process. Obviously, in the beginning of that process, it could happen sooner, inside of your deal cycle. But I think it's really important. Exactly what you're saying was kind of that post-LOI scramble is exactly what we're trying to avoid, right? Because
there's a lot going on during that 90 days.
And that is where every headache will happen, right? And what that allows the buyer to do on the other side isn't necessarily seller beneficial, right? And so what we see on the sell side is if they're able to, start when you guys go through that initial engagement process and have risk management be one of those pillars that you're tackling, I believe that, it prevents the headache on the back end, right? When in that deal cycle and you're, 2 months out from, potential sale of the business and you get a curveball thrown your way and, your seller is looking and saying, hey, we have to tell a really good story around this insurance thing. What are we supposed to come up with? Well, maybe 12, 14, 16 months prior to that, that's when that plan should have been put in place, right? Having that pre-LOI risk cleanup and allowing that seller to control the story through that process is going to be so important for them through it.
Great. So when you're doing that work during the deal prep phase, what are the issues you most commonly come across?
So a lot of the issues, and I think it ties back to originally how some smaller middle market businesses buy their insurance, right? So maybe every couple of years when you're going through the insurance buying process, right, you're bringing in 1, 2, 3 different brokers, having them quote the program, right? When those 3 brokers come in, quote the program, each one of them is going to hand you a proposal and say, hey, this is why my deal is the best, right? And then that seller is going to be, or buyer of insurance, if you will, is going to be sitting there and saying, I have to become the insurance expert now on these 3 different proposals. There's premium to consider. There's forms and endorsements to consider. So going back to your question, one of the things that we see is a lot of coverage gaps, right? Coverage gaps, coverage issues, that don't come up until later in that process. Another thing is claims history surprises, right? When folks aren't really looking at their loss runs frequently, us kind of insurance nerds, it's something that we love to talk about and look into and dive into as it relates to analytics and things like that around losses. But, people will look at their loss runs and say, hey, I didn't realize that claim settled for that.
Interesting.
So, another piece of it is, kind of in our upper middle market, if you will, is, program structure, right? On the sell side, if they're in a large deductible or if they're in a captive, there are a lot of different things to consider as it relates to collateral, inside those programs, and, could create some turmoil, come when they're trying to sell the business.
Yeah, I'm glad you brought up captives. That's the topic for another day, but when our clients have captive insurance, that's a whole other world of insurance things that we're not going to get into today. But I think, the process you mentioned of every couple of years pulling out the insurance policies and looking at it, you'd be surprised how many clients we have that, and maybe how many of our listeners don't actually do that. A lot of times they haven't looked at their insurance in a decade. And what we find is that, the buyer, as a professional institution, board managed type of company or private equity fund, they're going to have very strict requirements about what kind of insurance they want. And our clients often are not carrying that level of insurance generally because they got the right insurance at some point in time and they did not look at maybe increasing it, adding new lines, or the markets have moved. For cyber, for example, right? Where our clients come, they don't have cyber insurance because when they set their insurance up in 2010, nobody had cyber insurance. And now it's a requirement. And then the buyers look at that and they say, well, you don't have cyber insurance. This is too low. That's wrong. This has too many exceptions. Your insurance used to cost you this much. It's going to cost us this much. So your EBITDA goes down by that much. Yeah. You take that drop in EBITDA and you multiply it by the multiple, and that comes off the purchase price.
And things change. So I've seen, in my experience, policies that are 700 pages. That's a 700-page contract with a lot of words.
Yeah.
And words, I think they matter, right? So most buyers, most commercial buyers of insurance, your customers, right, typically see a summary page at some time in the insurance presentation cycle, but they really don't kind of get to the point of going through the process because they're entrepreneurs and they're busy
running their business.
That's why they hire us to go through that process. So we have to be really diligent when it comes to market cycles changing. We're going to be talking about a lot of seismic shifts in certain industries and changes in emerging risks. Those things can happen based on headline news on the fly that can impact someone's business pretty instantly. So you have to be pretty astute to go through the process to keep your customers informed. So I think it's really important to mind your P's and Q's when it comes to the coverage gaps part in the front end. You also want a little bit of industry expertise, maybe a whole heck of a lot of industry expertise that understands how your business operates and flows, because you kind of get to the heart of the matter when it comes to risk and more of the emerging risk. A lot of these entrepreneurs and business owners don't think backwards. They're trying to stay ahead of the competition, trying to stay in front of technology changes. So, yeah, it's really important, Kyle.
And I was going to say, part of that industry expertise as well, why that's important is because in that pre-diligence phase, Clinton, we talked about this before getting on here, but hey, if we're able to look at the program and say, hey, we can shave $100,000 off, what does that do to your
That's
side?
the upside, right? Yeah. So I mentioned the downside, which is you don't have enough coverage. And so I've dealt with enough business owners. They're hearing what I said is, this guy's telling me I got to spend more money. Okay, that's true sometimes. Like for cyber, if you don't have cyber, you need to have cyber.
Yeah.
And that's a new cash outlay to get cyber. But the flip side is what you just mentioned, which is another thing we see with the clients a lot of times is they haven't competitively bid, especially through a broker. Even they haven't even had a discussion with their insurance people, and every year the premiums go up. Or the insurance person comes in and says, "Oh, you're bigger. You should double your coverage for this." Okay, double my coverage. Okay, your premium doubled, and that's not the way it has to be. So we see this all the time. We're able to help our clients increase their EBITDA going into a deal by coming in and saying, "Yeah, our books show that we've been paying this much for insurance, but when we started this process, and we started working with Benchmark, they brought in Marsh. Marsh looked at this and said, guys, you're overpaying for a lot of stuff." I think, and it's not uncommon for us to have clients that both have gaps.
Correct.
And are overpaying for where they don't have gaps. So it's usually both, hey, get a little more coverage and pay less for the coverage you have from both sides. So I think that's, you got to look at it from both ways there. So cyber, I know, is one area where that's the one that comes to my mind is where our clients are most underinsured. But what do you see when you come into, say, business with, 50 employees, a top line revenue of $20 million to $40 million? What specific areas are they probably lagging on? Like, if you had to pick three and that's all you're going to get to look at, you'd look at cyber, and where else do you think they might be missing or underinsured?
Yeah, I'll take part of that. I think D&O is one place where private companies feel like they don't need, or they don't have exposure, they don't need coverage, and that couldn't be further from the truth. We've seen environmental, probably premises exposure on pollution come up a lot for that size businesses where they're not even, it's not even part of the conversation. Credit risk it is another one that you would pretty easy to procure and something that size business should be looking into and typically doesn't. Kyle,
Yeah, I would just say proper limit evaluation as well, right? And looking at what they do and just protecting the business as a whole. You'd be amazed with how many clients that we see or prospects that we go into that are carrying really small limits, and the business is grown exponentially. Like you said, they haven't taken the insurance policy book off the shelf in the last 10 years, and they've kind of been letting something auto renew, but all the while that business has been growing.
Yeah, we've had a really substantial change worldwide when it comes to social inflation. And social inflation, basically, for the audience, the way that I would describe it is, from an insurance perspective, is a value of a claim, right? Your typical slip and fall 20 years ago would be a $25,000 nuisance claim. Sometimes it's turned into $1 million claim, right? So the umbrella limits, I think understanding and using the financial statements and the balance sheet for any size company to kind of determine what their scope of risk is at the top end. So an umbrella or excess liability policy that kind of sits on top of your auto exposure, your liability exposure, sometimes your employment practices and exposure, workers' comp, those type of coverages.
Yeah.
That's where I think we in that level, 25 million and under those coverages, I think is where we see a little bit of pain points.
Yeah. Yeah, and I think we've had clients that can't find their insurance policies when they come in. That's not unusual, and it's also not a problem. If we can help them solve that and get that fixed up.
Kyle's really great at finding insurance policies.
Okay.
I haven't met anybody better.
Yeah. And I think one of the things that's important to remember, watching here is that Benchmark, we always tell our clients, run your business as if you're going to own it forever. So because some people come in and think, maybe I'll sell, maybe I won't sell, maybe I'll never get the right price that I need, and so they're not really interested in incurring a lot of extra cost and buying a lot of extra insurance. So I want to make it clear, we're not talking about insurance recommendations and these issues that we're spotting here aren't to make the company not the type of insurance that the buyer wants to have. They may want to have astronomical levels. That's up to them. What we're talking about is the kind of review that helps them whether they're going to sell or not. Correct? It's not. It doesn't cost them anything extra to do this.
That's right.
Right. And at the end of the day, they can still decide, oh, thanks for going over my insurance. I'm not changing anything. Right. And no harm, no foul. But one, they know. Two, we know if they've been overpaying, and we can pro forma the financials to help them. And three, they know that when that deal does come up, they're going to get hit for this, whatever this thing, for cyber. I keep going back to cyber. They're going to get hit for not having a cyber policy. So even if it leads to no action right away, it helps them if they don't sell, and it helps them get ready for the sale.
I can easily say, in my experience, 9 out of the 10 buyers that I see, and Kyle, you'd agree with this, buy too much insurance and buy too much of the wrong insurance. Without a doubt. I mean, we're big proponents of being able to use at any size company to use the balance sheet to be able to understand what you're purchasing and what you're transferring over to the marketplace. So it's not just the market gyrations and the flow of where the rate's going. It's really, am I making the best decision when it comes to insurance transfer, insurance procurement, right? Insurance policy across the board. So I think that's where we beat the drum. I mean, we're insurance people, but I think a lot of the conversations that we start off with is that you're probably you're transferring too much risk, right? And there could be a better way to do it, and you're probably transferring too much risk in certain places where you could reallocate some of those funds into something that's a little bit more top heavy from a risk exposure basis.
Okay.
Definitely, the buyers are saying that. In many different levels for certain coverages that I already mentioned. You mentioned cyber. Cyber seems to be when that's top of mind, where a little bit more robust kind of program, right, where you can kind of reallocate some of the dollar spend that some of the businesses are already doing. So
yeah, and I want to be clear. I mentioned earlier that Marsh is the largest in the world, but what size businesses will you work with?
So it's everything from low middle market to our big Marsh. Doing Fortune 500, Fortune 25 companies.
So our audience here is business owners, $500,000 EBITDA and above. You'd be interested in talking to all of them, right? If we, I kind of know the answer because I've been working with you. But so we bring you a client, you're not going to say, "Oh, we're Marsh. This is too small for us," right? So
no, it's right in our wheelhouse.
Okay, good. All right. So I think let's move on to our second topic: emerging risks, emerging in the market. What are buyers worried about now? And I've already kind of given away cyber is my thing, but so we probably don't need to talk about that one anymore. But what are you seeing as the biggest issues currently, and where do you see this going?
Yeah, so I'd probably put it in two different buckets. The traditional risks that we've seen as kind of developing and emerging. So. You mentioned cyber. Well, cyber looks different now than it did 5 or 10 years ago with artificial intelligence and how AI is really kind of developing real time every single day. The next one I would say is property insurance, just from the traditional scope of insurance. We've seen a really big change in weather patterns throughout the last 10 years up across the entire country, which has led to some pretty volatile pricing on the property side. Good news, everybody. It's gotten a heck of a lot better overall. But I think trying to ring fence certainty. As you know, in the financial marketplace, the worst word is volatility and uncertainty, and that leads to, in those two markets, some up and down kind of gyrations in general pricing versus something that's something that you can track and budget for. Budget's a pretty big word for a lot of our customers. The last one is probably auto and general liability for the traditional coverages because of social inflation, right? And the jury awards and verdicts and those type of things. So I think a lot of the buyers, when you think about insurance, that's one piece of transfer the risk. When you think about risk management, now you're getting into contract reviews, right? You're getting into some of the places where you can mitigate your operational risk by doing things a little bit differently from the operational side to mitigate your insurance spend, right? Or at least to kind of feel more comfortable with taking on more risk. So I think though, from a traditional coverage side, I think that those are the three that kind of stick out to me. The emerging risk side, the newer risk, I mentioned AI, but log on to CNBC, CNN, Fox News, some pretty interesting geopolitical stuff that's going on, that's been going on for the last couple of years, right? And you can wake up the next morning and there could be another headline. And I think that develops into a whole litany of risk, right, that could impact new and developing coverages, but then also kind of the basis of how the insurance market kind of flows overall. And AI, I mean, we said don't want to talk about cyber, but AI is, it's changing every single second.
So a lot of things I don't want to talk about need to be talked
Need to
about.
be talked about, yeah. So I think AI is going to create volatility. I think AI is going to create a lot of volatility from the business ops perspective, which creates a lot of insurance and new insurance products conversations.
Is that for a particular industry, or is that every industry that AI concerned?
I mean, I think it's every industry, and it impacts every industry a little bit different, Clinton. No doubt. Yeah. The last one that I would say is probably labor and workforce shift and some of the issues that we've seen there, and the general impact for a lot of our customer base, trade contracting, every industry that you can think of. I think that creates significant more risk and insurance issues across the board for our clients, where they have to redevelop their programs to kind of understand different types of risk, right? Or ask us for more advice on, how we can help when it comes to the human capital side of it. So
I think going back to the social inflation piece, right, and why that's so important is because there's a vast amount of underwriting scrutiny right now, right? You had mentioned, Walt, kind of some of those generic lines of insurance. We're in the state of Florida here. Auto insurance is a disaster, right? And it's an extremely frustrating thing for our buyers of insurance, our clients, and your sellers, right? When we kind of touching back again, obviously on the pre-diligence side, though, is when we're going in and looking at this stuff, we're understanding, how they manage risk, how they, their driving policies, all the different things that they're doing as an organization to really control that cost, right? Because, and then that flows into the emerging risk and the social inflation piece, because in the event of an accident, how are we responding to it? What are their policies and procedures, right? Because those things are so important due to, some of, like Walt said, the nuclear verdicts that are happening, not only in Florida, but, other states across the country. So, one small fender bender, is costing, a small business a lot of money on the back end as it relates to, their increase in premium over the next 3-5+ years.
Yeah. And it's statutory. I mean, you don't have, for the most part, everyone needs to purchase some type of limit of coverage for certain types of coverage, right? Including auto. So
is the underwriting process changing at all in today's market?
Absolutely. I think they're scrutinizing more and more. They want more and more data, and thankfully, like with AI, they're able to get more of that data and analyze the data a little bit quicker. But the underwriting process is slowing down because, for instance, we're just talking about the auto piece, right? The capacity and what carriers are interested in is getting smaller and smaller, right? They want to make sure that you have your ducks in a row and everything's, in really good shape before they offer you a competitive quote, especially for maybe some of your, clients that have a larger fleet, right? It's been a massive frustration for them for, I would imagine the last 5-7 years and going forward as well.
Yeah.
Yeah, we see that across the board in all forms of due diligence, but I've seen it in the insurance piece also, that it seems that the people that are demanding the data have all these great tools that they've paid a lot of money and they want to put them to use. So they're just doing more diligence. But meanwhile, people operating businesses who have a day job, their day job is not keeping track of all these files and data and things like that. The data they keep and the way they keep it hasn't changed as much. And so the gap between what the buyers want on all their aspects of due diligence, including insurance, and what the sellers have at their fingertips, the gap is getting bigger and bigger.
That's a great point. And that goes back to some of the conversations from the pre-diligence side around insurance. You don't want to be subject to the market gyrations, right? Mm-hmm. Property insurance. There was a time a couple of years ago where it was up. Some of our buyers had a 200% increase. They're seeing 40% decreases now. Yeah. Cyber, same way, up, down. But when I talked about previously about buying too much insurance, the cyber example again, a lot of our clients were reactive when it came to the market, kind of leading them into a different strategy, right? We want a strategy that lasts across any type of market condition, right? So some of our commercial buyers reallocated the risk transfer premium spend into infrastructure, into like you mentioned, data and kind of, but just hardening the infrastructure to make yourself a better risk. And we agree, right? So they come to us to consult for the basis of what makes the more sense to transfer the risk or to bring some of that money in-house to stay in front of all the things that are changing, and sometimes it's a combination of the both. Sometimes it's one skews more than the other. But that's what I meant by saying you need someone that understands. And this isn't just industry expertise. This is product expertise, right? So Marsh brings to the table not just individuals. If you had a contractor, we're going to bring someone that understands that business and talks the business. I always tell my team. I know we're talking about insurance in this entire, but you kind of lose the game if you're talking about insurance to your customer. You talk about their business, and by spending an hour talking about their business, you learn everything you need to know about insurance and risk, right? So I think it's important to kind of always focus on the actual business and then work your way down to the specific product. But as we all know, things are changing in this world, and you got to stay ahead of that risk curve. So.
All right, let's move on to our third topic. We'll talk about tail policies. Okay, so we started with kind of everything I think we said so far is good general advice for business owners, regardless of their size, regardless of their location. We work with you everywhere in the world. I don't think we've ever asked you a question where Marsh didn't have coverage in that part of the world and expertise and give us good insights. So everything we've talked about so far is very holistic. It's applicable to everyone. Let's get a little more into M&A here with our final two topics. So I'm talking about tail policies. Sometimes that's called runoff coverage. And so I'll give the layman's interpretation of it first. But so, when you sell your business and someone else takes over the business, something might pop up afterwards that happened before the sale. So the general rule is the contract gets written, that the purchase agreement gets written so that the buyer is responsible for everything that happens after the closing. The seller remains responsible for everything that happened before the closing. So sometimes an employee pops up after a deal is done and claims discrimination or anything. All your worst nightmares, you can all see easily how they would happen before, and you wouldn't know about them. You'd do your purchase agreement, you'd make your disclosures, the buyer would do due diligence. Nobody missed it because it hadn't manifested itself into a document or a complaint or whatever, or a loss. And then the loss happens, and then the buyer says afterwards, you caused this. So we're going to talk, both our third and our fourth subject are going to talk about how to address that, how to protect the seller with insurance tools for things that pop up after the closing. And so the first one we're going to talk about is a tail policy. And I do not want to talk about what I'm not qualified. So what is a tail policy?
I think you did a pretty good job explaining it. So I'll give you some credit there.
Absolutely. So essentially, it's an extended reporting period for a claims made policy, right? And I always think the best way to kind of
Can you talk, claims made versus occurrence basis? Can you just
I think the best way to explain that is always to give an example,
Yeah.
right? So say you have an architect. This architect starts his business in 2000. This architect sells his business in 2020. 2025 happens, and a claim comes up, claiming alleged damage to this architect's work in 2018. So while he still owned the business between that period of 2000 and 2020, but all of a sudden this claim comes up in 2025. And with architects, there's a lot of professional liability, right? Rendering professional services for what they do. And say this architect didn't purchase a tail policy on his claims made policy. Claim comes up in 2025. He submits it back to his carrier and says, carrier's going to say no coverage, right? And that's because he didn't purchase the extended reporting period for that claim, right? If it was a general liability claim in that period, right? If we're given the same example of 2000 to 2025, right? And that claim happens in 2018. He has a general liability claim. His general liability carrier from that year is going to pick it up, right?
So if he hadn't sold the business, he'd still have insurance, and the insurance company would look at what happened and say, you had insurance with us when this happened. You still have insurance with us. Everything's good. Let's proceed. But in this scenario, you're saying the business sold. So if it was, say, an asset deal, then the owner stopped paying insurance premiums because the company doesn't do anything. It probably doesn't even exist 2 years later. Or if it's a stock deal, the buyer puts the company on their insurance policies and the seller's insurance policies have terminated. So seller faces something, says, I paid for insurance for years, and they turn around and they find out they don't have coverage. And it's not a gotcha. If you think it through, it makes perfect sense, right?
Absolutely.
So how does a seller then protect themselves from that risk?
So purchasing the tail policy, and being able, I think the important part of that though is being able to quantify the runoff period that they want to purchase, right? Whether it's 1 year, 2 year, 5 year, indefinitely, right? And I think part of Walt and I's job and the other folks at Marsh is helping that seller quantify how many years they should buy, right? We have run into circumstances where people have sold their business and said, hey, I haven't had a claim on my, any of my claims made policies in the last 30 years. Why in the heck would I purchase one now? Very, very common, right? And we're saying, hey, you sold the business. You do realize now that in the event of a claim, if you don't purchase a tail, you're going to be on the hook for those claim dollars, right? You're going to be paying that claim yourself.
And I do know that there have been scenarios where there are people who might have made a claim, but they've been working for the owner for 20 years. They went to high school together. Their family, and so they let a lot of stuff slide. And then after the deal, suddenly they're more of an arm's length employee, and they kind of take a little more aggressive approach and stir the pot a little bit. So that's one concern. And then the other concern is that a lot of times businesses that are owner operator are kind of flying below the radar, and when a bigger buyer takes it over, suddenly people see them and might start gunning for them. So there might have been things that were happening and just being water under the bridge, that after a deal, for one reason or another, people are a little more picky or sense deeper pockets on the other side, and they pop up.
Absolutely. And I think one of the biggest misconceptions that a seller may have is thinking that a buyer's policy is going to cover them.
I agree that that's what we hear. And for some reason, I don't know why this is the case, but what we consistently see is buyers wanting a 6-year tail policy. That's 6 years. I can't remember the last time I saw a purchase agreement where it wasn't 6 years. And I don't know why, but we just tell the clients that's market, and then we have them talk to you guys and see what they say. But I don't remember anyone ever coming back, and it may just be that we're going to focus on other things at that stage of the deal, but I don't remember someone coming back and saying, no, I'm going to get an 8-year policy. Or maybe they just get the 8-year policy, but you don't need to put that in the purchase agreement. I got my 6 years, and I got 2 more, something like that. So do you see people going longer than 6 years?
Absolutely.
Yeah. And so I think one of the things you said is, why would I want a tail policy? I think one of the reasons is the price is surprisingly attractive. So, can you kind of do some ballpark math about, someone's been paying for an ongoing policy covering ongoing risks. How does that premium compare to a premium on a policy that only covers something that happened in the past?
Yeah, so I would say, even on people's current, if they're staring at their policies right now, as they're reading this and saying, hey, I should look at these claims made policies that I have, right? If they're looking at a professional policy, some of those policies will have in there buying extended reporting periods, right? It's okay, for 3 years, it's going to cost you 125%.
Oh, it'll already be in there, the cost will already be in the contract.
Yeah,
so
some carriers offer that, up front, and that's kind of a transparent piece of the equation, right? But once again, to Walt's point is some of these policies are 700 pages, right? So not many folks are looking at them these days.
Right.
99.9% of the insurance community that's out there doesn't know that they can pre-negotiate because it's part of the policy already incorporated. They can negotiate terms and conditions versus just some boilerplate. So almost nobody negotiates that. And I'm going to use the word benchmark because we're here in this beautiful studio. We have a lot of data, right? And you don't negotiate things after the contract has been signed, right? The insurance contract has been signed. You negotiate it beforehand, right? So we can, with our data sets at Marsh, we have the ability to use benchmark data to validate like the viability of the term, right? To give better guidance and or limits to give better guidance and consultation to our clients. So we like being able, of course, to do this in the front end, but if we do it in the back end, we like providing as much data as possible to be able to get a better outcome and solution for the seller.
One of the things that I see is that our clients are always pleasantly surprised at the cost of a tail policy. It seems that it's about a third. The premiums, it depends on what type of risk exposure they have, what kind of policies they have, but generally, I would say if I had to make a ballpark estimate, it's about a third, whatever premium they were paying for an active policy for each corresponding tail period is about 1/3 the premium. Does that sound about right?
Yeah, absolutely. Right. Obviously, that is dependent upon the number of years purchased, right? You're purchasing 3 years, it could be around 125% of what their annual premium is.
To cover 3 years.
For 3 years,
yeah.
Correct. And then, for a 5-year, it could be 150, and then for maybe potentially more than that, up to 200%.
But it averages out to
Yeah.
about a third.
About a third. Okay. Yeah, that's good. So I don't recall ever having a client, at first and say, I got to buy something else. I got to pay for something else. I thought I was selling the business. So we have our explanation. You get in, you give them the better explanation. And I've never had someone afterwards say, I don't want to waste money on a tail policy. They're always like, oh, that's a great idea. So it takes a little convincing. I know.
Absolutely.
But at the end of the day, everyone's always very pleased about spending a little bit of money to get that coverage.
Yeah, Clayton, as we talked about, tell your clients to pre-negotiate these tails.
Yeah.
Because instead of it being a third, it could be a fourth, or it could be so there's opportunity.
Yeah, that's always when you go in and say, I need something. Suddenly it costs more than, hey, I'm probably never going to need this, but. Right. Okay.
Yeah, that's right.
And then I was going to ask. I had another question there. Suppose that a seller doesn't have a type of insurance, and then they learn about it and through our process, and they say, "Oh, I need a tail policy for that."
Yep.
Can you get a tail policy on something you didn't have a policy on?
Yeah. So we've done that in 2025. For about 10 transactions or so. It's called a naked tail.
Naked tail.
Naked tail.
Never heard that term before.
Yeah.
Okay.
But basically, it's purchasing a tail for the legacy risk in similar way that you would transfer the policy. So it's quite common, especially as you go, like you were mentioning about what insurances certain buyers in certain segments don't have, right? Mm-hmm. I mentioned environmental coverages. Those are a lot of those policies are claims made. I mentioned D&O. Almost all of them are claims made. So it's a lot more common than you think. So great question.
Great. All right. And so what about mistakes so is it possible for someone to make a mistake other than not getting tail policy? I mean, at the end of the day, it has become so universal that the buyers put the clause in the contract that the seller makes a representation that they have a tail policy to last 6 years. So assuming the buyer makes them do that, are there mistakes that they can make on a tail policy, things they need to be on the lookout for?
Yeah, I would say relying on their incumbent carrier to provide the tail coverage.
Well, you can switch. I guess that makes sense. You can go get a naked tail policy from someone else, or
Yeah.
is there another term for that I don't know?
Yeah, exactly. Same concept, but
Okay, so you can shop it.
that's
You
a
can shop it
strategy in
for
the
them.
competition,
Okay.
competitive landscape. Yeah.
Yeah.
Yeah, exactly.
But making sure that you have
This is what happens. I work with you guys so much. I just hand it off to you. You just take care of it, and I don't even know what you've done.
Yeah.
So this is educational for me. It's great.
We need to do a better job of briefing you after everything is done. But
That's
no,
right.
it's
I would say retro date, right?
Big
Making
deal.
sure that
Yeah.
the retro date is
The retro date.
Yeah.
What does that mean?
the retroactive date, right? When the policy was first put in place, right? So when a claim can be
Oh, how far back it will look?
Yeah.
correct.
Is there like a tendency if someone doesn't know what they're doing, you just get a 1 year look back or something, or what?
Or I think some of the issues that we've seen in the past is that when people switch carriers, sometimes, obviously not with our team, right? But their policy won't follow that retro date, right? They'll get a new retro date based on when they wrote that new policy. It's a pretty common mistake that we've seen, right? But then it limits that coverage for the year prior, or for however many years prior that retro date was.
yeah.
Okay.
And this goes a little bit away from tail, same concept on the pre-diligence side, but we've had experience with retroactive dates going back 15, 20, 25, 30 years. And you ask one question in a certain marketplace and say, well, wait a second, there's a certain statute for that risk or whatever else. And you bring it up, right? And you have a conversation with the client to bring it up. It could change the premium by 20, 30, 40%, right? Because the carrier is not carrying that legacy risk dating back to where there's some phantom thing. But it's a conversation. I mean, we've had clients in jurisdiction matters, the client industry matters, because there's been places where governments interceded and tried to kind of impose no statute of limitations. So we have conversations around those type of issues before we make any type of decisions. But we want to make sure we're transparent when we're talking through that, Clinton. Yeah. So as you can tell, we love strategy. You called us a nerd in the beginning. I take a little bit of offense to that, but the strategy is key. You got to be strategic when it comes to risk.
Okay. So kind of wrap this subject up.
Just kidding.
Kind of take a step back, still looking at tail policies and like kind of overall exit planning. How would you describe fitting in the tail policy thoughts to your overall strategy?
I'd say a big part of that is personal balance sheet protection, right? So that seller can go to bed that night, they sold their business, lay their head on their pillow, and know that, if a claim comes up, there's going to be coverage for it.
Yeah.
Right. There's a peace of mind to having it, right? Like we talked about the cost earlier, but the peace of mind is extremely important for those folks as well. And once folks understand, how the tail policy works, they understand the risks that they have, right? So, and sometimes it takes a couple conversations, because the last thing somebody wants to do is spend more money on insurance when they're selling business. But
It's interesting to watch our clients focus change as we go through the process, right? So the beginning of the process, it's all about maximum cash, low tax rate, cash at close, and that's kind of what's on their mind. And then they kind of morph into this kind of, I want to make sure the buyer's the right fit for my business and my view of the future, and every client's different, but there's kind of a general arc. And then towards the end, it's like, when this is done, I want to know that it's done. And that's really where the insurance piece comes in. And so the tail policy is half of that equation, and it is very hard to talk with our clients about insurance early in the process because there's so many other things they're focused on. But at the end, man, they really get focused in on that, And so the tail policy, we'll move on to the fourth and final topic here. So the tail policy being the third one, that helps them deal with the risks associated with the historical business after the closing. But the fourth thing we're going to talk about is representations and warranties insurance, called or reps and warranties insurance, or RWI. And it's something that didn't exist when I started doing mergers and acquisitions. And then, it started like a lot of things in the M&A industry. It started, and in the insurance industry, I imagine, it started with large deals. There weren't many carriers that provided it in, say, the millennium, shortly after 2000. There weren't many providers that provided it, so it was not a very competitive market. So the pricing was high. We were paying a lot to get that coverage in terms of looking at it on a ratio basis, and but it's crept down. I've just seen it creep down. I cannot remember selling a business with 10 million EBIT or above that did not have reps and warranties insurance in the last 10 years. I think I'm not good with time, but it's certainly de rigueur for a certain size. And every year, as I look at our smaller deals, it's become more and more affordable. There was a little blip in 2002, 2003, something like that, where the prices went up. A lot of people, I think it was a year when people were thinking there was going to be a tax change. So the Q4 got swarmed with deals. All the insurance providers got busy. So they raised their prices. They started putting in more exclusions, and it was kind of hard to get it for a little while. But then within 3 months, it was back to just even better pricing than ever. So every single year, I've seen the pricing, with that one exception, I've seen the pricing go down. And it's always been, it's never interfered with closing a deal that I'm working on. If we get it to you in time to shop it, it gets done. The insurance, the brokers drive that piece, the insurance brokers drive that piece of the process, and the insurance underwriters know that if it's not done in time, the deal's going to go on without them, and you're not going to really recommend them on the next deal. So you can hold their feet to the fire. So these underwriters get in remarkably fast and get this insurance in place. So this is something that does come at the end of the deal, and so maybe I'm getting the cart before the horse here. Let's talk about what is reps and warranties insurance. How does that protect the seller? Why does it exist?
Yeah, so it actually protects the buyer and the seller from financial loss due to breach.
Breach of
Purchase agreement or a rep.
reps and warranties. Yeah, let me preface that a little
Or
bit.
a warranty.
So in the purchase agreement, the parties are going to make certain representations and warranties to each other, and the buyer makes this many and the seller makes this many.
Right.
And it's 15, 20 pages.
That's right.
A big chunk of the seller's legal bill will be spent negotiating those terms and putting in knowledge qualifiers and materiality qualifiers, and then they have the opportunity to, it says, we've never had a lawsuit, I'm paraphrasing, and then they'll work with their attorney and they'll say, except for the 3 items on Schedule 2.12, there's never been a lawsuit. And so that then gets them a free pass on those lawsuits because they've disclosed it, but sometimes something pops up that you forget to disclose, or the buyer reads the representation differently than the seller. And so after the deal closes, the buyer comes back to the seller and says, you made you guaranteed me something in the contract. You said there had never been a lawsuit.
It's a tax issue. It's legal compliance issue.
Yes, we've paid all. And lawsuit's a bad example,
Right.
Yes, we've paid all the taxes. Well, you probably should have started paying taxes in California 2 years. You forgot to collect sales tax in Nebraska, and these things pop up after the deal closes. And it's not fraud. We're not talking about fraud. That's kind of outside of this. This is just an honest mistake that the seller makes.
That's right.
In the hubbub of the 90 days of due diligence and all the whole process, right? So these mistakes can come up. And so what normally happens is the seller has to leave money in escrow. We see that being between 12 and 24 months. Very often it's 18 months. And very often it's 10% of the purchase price. That's the traditional pre-reps and warranties model. All right, I'm going to buy your business for $100 million. You're going to leave $10 million in an escrow for 2 years. How can the buyer take the money out of the escrow? Well, when that tax bill comes in from Nebraska, I'm going to pay it with that money, and you're going to get less money. You're not going to get the
Right.
this example, $10 million. When the escrow time is up, you're going to get $8.2 million or whatever.
You go through the audit cycles, you go through the tax cycles, and right.
Yeah.
I wanted to go back to what you said around the state of the market
Yeah.
for reps and warranties, and kind of align it to just a broader, insurance is a financial product, right?
Okay.
Sometimes there's ideas that we have in our head in the insurance space. This is from the risk taker side that say, you know what, we can establish a market with this, right? And there's a maturation process to where it's legitimized, like employment practices liability in the 70s and 80s, where it didn't exist. Insurance existed. It became profitable. They probably change it and what it looks like, right? And it redevelops every certain years in certain areas in certain places, or it just or products go away. The reps and warranties market has matured greatly in that time frame that you talked about. There's never been a time. There's about $1 trillion of underwriting capacity out there to write deals, right? With 30 plus carriers that have an appetite from the smallest deals that kind of fit within the scope to the largest deals. You mentioned, good buzzword is always pricing. We were talking about the tail pricing and everything else. Pricing is almost at historic lows when it comes to the average price. So 3% of the limit. So if you carry a $10 million limit, it's going to be a $300,000 premium, and your deductibles and retentions, those have tapered off from the original start 10, 15 years ago, and they're about 0.5% of enterprise value overall. There's certain sectors that probably have a little bit more heartburn when it comes to the underwriting process, because they're kind of tied into some more regulatory issues, like healthcare is a good is a great example of that. But for the most part, and you mentioned it, the underwriting process has been pretty streamlined. It's matured greatly, right? It's a much easier process for our customers to go through, across the board. The last point that I would make is it's kind of a little bit of an interesting market where you have relatively historical low rates, Clinton, but you've had more claims in 24 than you've had ever in the reps and warranties space, right? So I think sometimes the cycle for where the market catches up for any product is a little bit, it takes some time to get there, but there's risk. That's the point, and it's risk in maybe newer developed type things where the product didn't cover certain things 20 or 25 years ago, and it's kind of developed into just a little bit broader risk-taking perspective. So, I think it should be a part of every conversation for every client that you have, but especially in the pre-diligence side, because you get to kind of understand some of the way the market works and be better prepared for when you get to the point of just going through that 90-day process of trying to do everything at one time. So
yeah, I think that this kind of looking at that chronology and the development, I would think, say 5 years ago, this would come up when the first draft of the purchase agreement came out, and the buyer would be proposing it, and it would show up unannounced in the purchase agreement, and then be discussed at that point. And then for the next several years, we started making sure that we get it in our letter of intent. So we have the conversation with our client before they sign the letter of intent and say, you need to really understand reps and warranties insurance, and you're going to want it there. And this is right when they're starting to feel like this is really going to happen. And they go through that arc that I talked about, and they start saying, I want to make sure when it's done, right? Or alternatively, the buyer wouldn't bring it up, and they would see, on a $100 million deal, wait, $10 million is getting left in escrow over 2 years, and that's just very uncomforting. Yeah. And so we say, well, look, let's propose reps and warranties insurance, because that's that is the way to avoid that. That escrow comes way down from traditionally 10% of the purchase price to just half the retention amount, right? Retention, again, I'm not an insurance person. Retention to me is deductible, but it's called a retention.
Same thing, different.
So so the half the deductible on the reps and warranties insurance policy gets left in, and for some reason, the market seems to want the buyer to pay half the premium and the seller to pay half the premium, and the buyer to be on the hook for the first half of the deductible or retention payment, and the seller to be in charge of the second half. So it's the insurers demand that the cost be split 50-50 to the buyer and seller, which makes, that's just great because it's one less issue to haggle over the table.
Right.
So is that pretty, am I right? That's pretty consistent. That's what you're seeing.
Yeah,
Or
but-
different carriers doing it differently.
Well, I mean, I think insurance companies want to write deals, so there's flexibility to do everything. But that makes a deal run like the haggle piece of it, kind of the point from A to Z, right? To get the deal done. I think that's the way you described it is the way that it typically kind of shakes out. But sometimes you have buyers that command something different. Sometimes you also have questions around the basis of coverage, right, and what we're actually covering, and the risk perspective that comes out in the underwriting process.
Yeah, the debate we see most often is how much coverage is
How
going
much
to be
coverage.
bought, right? So the purchase agreements traditionally, again, even before there's reps and warranties, there was a cap on the seller's liability for a breach of the reps and warranties.
Yeah.
Again, other fraud's a whole different game. But accidental mistakes on the reps and warranties, and it was back in the day it was like 50% of the purchase price, then it was 20%. These days it's usually 10% of the purchase price is the cap.
Yeah.
Which coincides with the escrow, right? So your whole liability is within that escrow, except for fraud or maybe a couple other exceptions. So the question is then, do you buy an insurance policy that covers up to that cap, or do the buyer and the seller negotiate a little bit and cover 2/3 of it or something like that, and then they live with it? And so then the escrow goes down no matter what. Once you get the insurance, the escrow goes down, the seller gets more cash at close. The seller only has to worry about that half of the deductible coming out of that escrow, and then obviously if the coverage limit gets exceeded, then that's different. So there is still some negotiation that's required. So we don't like to save it till the last minute. But do you see other kind of, again, mistakes that people make or problems that arise in a deal?
I was just going to say part of the, going back to pre-diligence again, is making them aware of this process that they're about to go through, right? And I think that's so important because if you're in the 11th hour and they're just learning about what it is, it's going to be a headache, right? Because it can be a relatively complex insurance product, right? And they've already got maybe a tail policy on their mind and other insurance questions. So if we can, pre-educate, the seller in the beginning of this process in that, 1 to 4 month period, it just makes the process go so much easier on the back end.
Yeah.
And there's different, the transactional liability scope of expertise has become really micro, right? Reps and warranties is kind of the broader scope, but specific tax expertise within the realm of in and around a sale, contingent liability has come up as relates to the transactional piece of some known risks that you have within the deal flow side. So that market again, it continues to develop, but to the point that we're talking about here, we've seen it drop down significantly in the realm of and into the lower middle market space, right? And it traditionally hasn't, but it's there and it's been there, and there's a lot of supply coupled with a lot of demand. And I already mentioned to you, 2024 was the toughest year from a claims perspective for that marketplace overall. So I think we want our buyers to be diligent around the process, the product, and the options that they have throughout the sales cycle. Yeah.
Yeah, I think so. So the benefits of reps and warranties are that the smaller escrow, the seller has that more peace of mind that you first brought up of when this deal's done, I have little to worry about. But the third thing that I find also is that it cuts down the legal bill significantly.
Yeah.
Because when most of our clients are selling their business for the first time, so they sit through the 15 to 20 pages of reps and warranties with their lawyer, and the lawyer does their job and goes through every sentence and says, what this means is, now, are you sure you don't have this? Are you sure this never happened? Is there anything out there like this? And the client's like, let me get this right. If I don't answer you correctly, I'm personally on the hook.
Yeah.
Right. Yeah. And by the way, after you sell the business, you're on your own, and the buyer is not. And right now you got a whole team with you helping you negotiate this stuff out and protect you. When the deal's over, something pops up a year later, you're on a beach somewhere and you got to come back and figure this all out. It's not an enviable position to be in. But you know what? So they get very involved in the wording, the reps and warranties, and the deals get hung up, and sometimes get delayed. But the insurance companies will look at those reps and warranties, and they have a very standard view of what they should look like. So it takes a lot of the personalization out of the negotiation. So we see the purchase agreements getting turned back and forth between the lawyers faster. We see fewer turns going back and forth because reps and warranties is where a lot of that, a big chunk of our clients' legal bills get spent on that. And so we see the deals getting delayed less, and we see the legal bills being smaller for our clients when they have reps and warranties insurance. I'm not saying it decreases it by more than the premium, but it could be pretty close sometimes. I think
it definitely leads in our mind what we've seen and feedback that we've gotten to much smoother transactions, up and down, right? And a lot of your sellers are first timers, right? So I think without question, it should be part of the conversation for everybody, regardless if it's a fit or not, right? But from our perspective in the insurance risk and risk management insurance side, to be able to provide some transparency.
It's a no-brainer. It's a no-brainer. And every once in a while, we'll still see a buyer that doesn't know what it is.
Yeah.
It's first-time buyer, usually like a strategic buyer. They're doing their first acquisitions. Like, we gotta be kidding me! Come on, we're gonna do this. We gotta do this. So we've actually had. Sometimes we have to encourage our clients to investigate it a little bit on the sell side, but once they investigate it, they love it. But the hardest thing we've had, I'd say, in the last 3 years is that every once in a while there's a buyer who's like, yeah, no, we're not interested in that. Like, what are you talking about? And it's another reason that it's really good is we hardly ever see a case where our clients sell the business 100% and walk out the door. So oftentimes they're rolling over some equity, maybe 20% of the business they're still going to own. So they're a minority partner.
The buyers want them to be involved.
With the buyer.
Yeah.
And they're there to make sure nothing gets, the institutional knowledge doesn't leave. And the buyer wants them to stick around and work there for 3 years or something to make sure that, that nothing falls between the cracks. And oftentimes our clients want to stay on and they want to go to the next step. And they're viewing this as an elevator deal, helping take the business to the next level. And they want to be there. And the worst thing you'd want to do is have a reps and warranties claim, that the seller doesn't agree that they made a mistake.
That's right.
That's not what that sentence means. That doesn't qualify. I'm not responsible for that loss. And their business partner, who's bigger than them and runs the board of directors or whatever, is saying, you're wrong. I'm gonna take money out of that escrow. And then you've soured the whole relationship. So I think that ability to have a good relationship, because the size of the retention, to me, seems like it's always small enough.
Yeah.
It's not going to blow the relationship. The buyer and the seller are going to have a complete disconnect on whether or not it's a legitimate claim, but the seller, is not going to, it's a couple $100,000, and I just got 25 million. So it seems to kind of really preserve those relationships afterwards, which is an important piece of it.
Yeah, the buyers have said that post-close protection, right, and the mitigate or eliminate the disputes part of that, because that can get tricky towards the end. So that's the purpose of insurance, right, is to have legitimate risk transfer on the basis of and that gets into the crux of things that are probably not as a little bit more gray. Clinton, right? Like the basis of interpretation of what the intent is versus you insuring your building that's made of concrete. So we have experts there in that field. We have the underwriting community that's all that if they're focused on that, that's all they do. And it's important to have individuals that do that within the product line, because the product changes all the time, right? It develops positively or negatively. And it's our job to be able to bring that transparency to the client of how the market changes. So
to sum that up, the reps and warranties insurance is going to be pretty much available for anybody who might be watching this, selling their business.
That's right.
The pricing is deemed very attractive by owners selling their business. It gives the peace of mind. It helps preserve the relationship. It helps reduce the legal bills. It helps the deals get done faster with less headache. And every deal's a headache. You get into that last 90-day period, we take a lot off of our clients' shoulders, and the lawyers that they work with take a lot off their shoulders, but it's tough, and they still got to hit their numbers. They still got to run that business. The whole thing might still fall apart. It's just, I see when the reps and warranties piece gets put in place, I see that burden being lifted even further, and it just helps with the mindset of getting through the deal.
No other firm in the world does more reps and warranties insurance than Marsh. You also need the expertise to back through the consultant piece to back through the end result. Right? You need an advocate to go through that process, because there's some things in the underwriting side that sometimes we may or may not agree with. Right, so that the basis of having folks in there to be able to guide you is why we're here. So
and so just to remind everyone how insurance brokerage works. So someone comes on board with us, we're working with them, we say, hey, it's stage where you should get your insurance looked at. What do they pay you to have you look at their insurance?
Nothing.
That's how it works. It's not an extra cost. So why not do it, right? And you're going to go through. You're going to talk a little about reps and warranties, but you're really not going to get into that. But the first couple things we talked about are, let's look at your existing coverage. Do you have enough coverage, the right coverage? Are you paying too much for the coverage? And what's changing in the market? And let's talk about that tail policy, because it doesn't cost you money to get those tail policy terms put into your insurance policy. If you can negotiate them well, and you have someone who can help you negotiate them with the insurance carrier, then you get those things in, and then your insurance is in line going into the deal. And you understand reps and warranties, so if it comes up in a conversation with the buyer, reps and warranties insurance comes up in a conversation with the buyer on the first call or first visit, you sound like a serious seller. You know what you're talking about. You impress them. It helps drive the ball forward on the whole deal. And that's really the name of the game. And that's really, if I could convey, that would be my kind of closing thought to everyone is this adds value, and it's going to add value whether you do end up selling or not selling the business. And it's no cost. So it just should be one of those things that's handled in the first couple stages. But if we go to our closing question, I'll put that out to you guys. So if you could give sellers one piece of advice, and I know I deliberately took the best piece. So another piece of advice regarding insurance before they start the process of selling their business, what would that be?
So I would say just start early. Right? Understand your policies, understand what you have in place, right? It's not your job as the seller to understand that. You have a broker that's going to come in and that should be meeting with you frequently to discuss your risk. And if you're having conversations with them about selling the business, pre-diligence phase is really important, right? And when you work with Benchmark, you have the ability, to look at things and uncover things that maybe you didn't know were there. Right, and I think it's so important that if we're starting this process early and not in the 11th hour, you're going to be fully prepared to sell the business. Risk management insurance is not going to hang up your deal if you know everything in the beginning.
Okay. Anything to add, or have we stolen all the thunder?
I said it in the earlier part of it. Find someone that knows how to talk your business, right? And then the other part is you're probably buying too much insurance. So call us to make sure that you're buying the right insurance, right? And ultimately add value to your program if you're thinking about selling, because as you know, it turns into what the actual outcome is going to be for them overall. I've been in this business for 24 years. I've seen claims as high as $150 million. I've seen uncovered claims where the clients didn't have coverage in the $50 million range. So insurance is important. Protect yourself against the biggest catastrophe that you can think about, but have the right people on your side. So
Okay, all right. So, given that I assumed that any questions we might have would be highly technical, and I didn't want to put my guests on the spot here, so I didn't ask for questions. But if you look on the right-hand side of the of your screen, there's a place that you can submit questions, and we'll get back to you with the questions. But we want to make sure we have a chance to all kind of vet the answers before we get back to you. But we will get back to you. I'd love to answer your questions, and you don't. Even if you're not thinking about selling the business and you want to get a hold of these guys, the contact information will be somehow tied into this webinar. So you can go and you can start that insurance thing before you even talk to us if you want to. So thank you for your time and look forward to seeing you on our next installment.